Welcome everyone to the Advanced Portfolio Strategies 2023 Halftime Report webinar. We're delighted to have all of you here today, and we're looking forward to sharing some very good information with you. Let's see. I want to draw your attention to these required disclosures. Please take a few moments to review them. Obviously, if you have any questions about them, but important information to get out. Okay, moving on. I want to touch on a quick housekeeping item before we actually get started on our agenda today, and that is to highlight a few bullet points around the TD Ameritrade institutional merger with Charles Schwab. Some people have had some questions, some very good questions, and if you have questions, you can always call us later. Or ask us at the end of our webinar. But I just wanted to point out a few key things. So first of all, this change of custody is not going to require any kind of new paperwork on the part of the clients. It's going to be seamless. It's going to go over automatically. The only thing that our clients are going to be required to do is to confirm or get new login credentials for the Charles Schwab site. That's, from our understanding, that's the only active thing that our clients have to do because it's an access issue. From the investment portfolio, the move money authorizations, all the ACH transfers and things like that are automatically going to sweep over into Charles Schwab, so we shouldn't have any issues there. There's certainly no custodial risk created by the transfer. Schwab is actually bigger than TD Ameritrade, and combined, they're going to be like sort of the 800-pound gorilla in the market. So we're not going to a higher risk or custodian. Charles Schwab is the leader in the market. From our perspective, our portfolio management perspective, our capabilities are going to remain the same. We're going to continue to use the portfolio management software that TD Ameritrade had embedded in its website, which is a very, very good software. And in fact, we're already putting new clients that we're taking on into the Charles Schwab platform. So we're already very familiar with it. It's just going to be, as of September 5th, all those accounts that are at TD Ameritrade are going to be on the Charles Schwab site. And then we're going to have to make sure that all of you have logins and make sure that you have access. It should be fairly seamless. Obviously, if any issues come up, you should be talking with us about it. We'll help you get onboarded into that new system right away. My understanding is there will be a new Schwab account number assigned, and statements are going to be delivered under the same method that you had chosen under TD Ameritrade, whether it was paper or email. So those should all stay the same as well. You'll be getting more communications from us over the course of the summer in this regard, but we're well underway. And like I said, September 5th, after the holiday, everything's going live, and you will not be able to access the account on TD Ameritrade. So before that time, you're going to have an opportunity to get your login credentials so that you will be able to see it on Charles Schwab. Okay, I think I'll leave it at that for now. Today's agenda, I'm going to focus on four key areas. First, reviewing the first half, and then taking a look at potential market forces in the second half outlook, and then kind of ask the question, where are we now? And then after that, take a look at what's ahead for the second half of 2023. So let's begin by reviewing how the stock market performed during the first half of 2023. Here's a snapshot of the S&P 500 index performance from January 1st, 2023 to June 12th, 2023. The S&P managed to post a gain helped by evidence of slowing inflation and the prospect of the end to the Fed's rate hike cycle. The communication services, consumer discretionary, and technology sectors were among the top performers in the first 5 months. Of course, a lot of those had been beaten down in 2022. The first half was dominated by three overriding themes: inflation, rate hikes, and recession fears. I think we've all seen a lot of that in the press. As inflation continued to moderate and the Fed signaled that rate hikes might be nearing an end, fears of a potential recession became the dominant investor concern. In addition to these macroeconomic worries, the markets grappled with the regional banking stresses in March that periodically resurfaced in the months that followed, as well as having to cope with the uncertainty generated by federal debt ceiling negotiations. We use a chart of the S&P 500 Composite Index because it's generally considered representative of the U.S. stock market. Now, just a couple of caveats. Index performance is not indicative of the past performance of particular investments. Past performance, obviously, in any index does not guarantee any kind of future result. We're just looking backwards and trying to understand the reasons why the market may have performed the way it did. So we've talked a bit about how the S&P 500 performed so far this year, but how does that performance compare to what those expectations were? At the end of each year, various media outlets compile some Wall Street analyst predictions for the year ahead. This image shows several projections shared at the end of 2022. How do those predictions compare to the reality so far? Well, the S&P 500 closed on May 31st at 4,180. The S&P closed at 3,840 on December 31st, 2022. So year to date, stock market gains have been pretty solid. This is far better than most experts had predicted, with full 2023 full year forecasts for very muted coming off of a down 2022. Even the most optimistic forecast in this table represents a less than 5% increase for the year. The outlook was very reflective of expectations that the economy could potentially fall into a recession, while interest rates would likely continue to go higher. So this just goes to show predicting where the S&P 500 will be by the end of the year is always challenging, especially this year in 2023, given the uncertainties that we have of inflation, global economic growth, and rising interest rates. In the following slides, we're going to discuss the factors that may impact stocks in the second half of the year. Now, to create some context about where the economy may go in the second half of the year, let's start by examining where we stood in January 2022. We picked this month as a reference point since it represents a moment in which the pandemic was now mostly in the rearview mirror. As the indicators suggest, the outlook for the coming 3 to 6 months was exceptionally optimistic. The Federal Reserve's monetary policy remained accommodative, and interest rates had not yet begun their climb from their historic lows. On virtually every important economic indicator, from inflation and monetary policy to credit demand and availability to energy costs, it was flashing positive. Only 3 indicators were neutral or cautionary: the political environment, equity market valuation, and geopolitical risks. There were no negative indicators. However, those conditions would soon reverse. Now let's jump to January 2023. In the short span of just 12 months, the economic outlook has done an about face. We went from a set of speedometers that were nearly all positive to an outlook that contains no positive economic or financial indicators. After almost a full year of sharp and successive interest rate hikes by the Fed, there are now 7 indicators flashing red, most notably monetary policy, interest rates, housing, and leading economic indicators. The rest of the indicators are neutral. This is a good illustration, I think, of the impact across the economy and the financial markets of going from near zero interest rates to about 5% in roughly a year's time. And things do not look much better 6 months later. In fact, you could say that the outlook has maybe even deteriorated slightly. As of June, we sat with 7 red and negative indicators, the same number as January. Perhaps the most notable change is that credit demand or availability has moved into the red. This is in part a consequence of the regional banking troubles we saw flare up in mid-March with the collapse of two mid-sized banks. This banking stress has led many institutions to a more conservative approach to lending money, reducing loans to shore up and strengthen their balance sheets. This may have a significant impact or a significant economic implications, since consumer and business borrowing are a major driver of economic activity. Fewer loans, in other words, may mean slower economic growth. So to that point, let's examine what leading economic indicators are telling us. We're going to start here with corporate earnings. This chart shows the relationship between changes in S&P 500 performance and the 12-month forward earnings per share. As you can see, the two lines have generally moved in the same direction over the past decade. However, as we can see, stock prices progressed ahead of earnings growth, which was then followed by a retreat in prices in 2022, right? You can see the S&P, the orange line, and it was well ahead of the 12-month forward earnings per share outlook. And then recently in 2022, we saw prices decline, and now they're back sort of in tandem, right? So the earnings have trended sideways for some time now, as you can see. However, more recently, stock prices have been trading in a limited range, possibly due to a lack of clarity surrounding corporate earnings. Next, we'll take a quick look at inflation. At the highest level, the Federal Reserve has three functions: to provide an effective payment system for the U.S., to regulate banking operations, and to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it to determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. The charts we're looking at depict consumer price inflation on a year-over-year basis and a month-over-month basis. As you can see, the year-over-year inflation number are trending lower, though inflation remains above the Fed's target inflation rate, which is one reason why the Fed continued to raise rates during the first half of the year. When we look at the month-over-month chart, the numbers can be a bit more erratic. Expect the Fed's decision on monetary policy to continue to influence the financial markets through the second half of the year. Here, this next chart, I threw this in here really to kind of illustrate, the overall trend of inflation. I think this is important to understand because you see this big spike, towards the 2021 through 2022, and then all the way back down. There was a lot of debate about inflation being, was it transitory or not? And I would argue that it actually was transitory. People say, no, it's been here for a few years, but the reality is it took about, depending on what time frame you're looking, about 13 to 18 months to reach peak inflation. And here we are on the downside of that as the Fed ratcheted up interest rates to control that inflation. Now it's already on the way down. And I believe the expectations right now, like the next reading is expected to be below 3%. So the range that the Fed works on is 2 to 3%. So it was at 3% at the last reading, and they expected it to come below. But basically, we're at the top of the range. And so we've come a long way. I'm gonna delve into this topic a little bit more later in the presentation, but I want you to keep this in mind, this idea about inflation being transitory and where interest rates are, because this is ultimately what's had a big impact on in the markets in 2022 and continue to have an impact in 2023. I'm going to move on right now to the labor market, though. So amid the challenging headwinds in the first half of the year, such as interest rate hikes, those regional banking stresses I talked about, and a slowing economy, the labor market has been very, very resilient. Despite all the news of layoffs, particularly in the tech sector, a potential looming recession, and higher business costs, the U.S. labor market remains pretty healthy. This labor vitality was an important support to the market, since having a job is obviously foundational to consumer spending, which drives economic growth. This strength may be best illustrated by two labor market measures: the unemployment rate and current job openings. The unemployment rate continues to remain at historically low levels thanks to robust hiring by private sector employers. Even in the face of this robust hiring, the percentage of companies unable to fill positions remains quite elevated. So by these two measures, we actually have a fairly robust labor market, and you will hear that in the news and the Fed talking. If you're reading your financial news, like that's ironically, it's one of the things the Feds are pointing at in their concern about inflation is the labor market's too hot, which is interesting by contrast, because since the great financial crisis, one of the things that the Fed was always worried about was the labor market being too soft. And now here we are, when we have a good labor market, now it's a cause for concern. It's interesting how that pivots back and forth like that. I'm going to move on and look at consumer sentiment. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable as it surveys at least 500 residents of the U.S. each month by phone. The survey uncovers consumers' opinions regarding their own finances, as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of the gross domestic product, or GDP. As this chart indicates, consumer confidence recovered from its historic lows in June 2022. More recently, those gains have eroded as recession fears and concerns over the debt ceiling increase consumer pessimism over the near-term health of the economy. And I'm going to touch a little bit on the regional bank stresses that we were seeing a few months back. The financial markets were caught off guard by troubles at the two regional banks in mid-March, Silicon Valley and First Republic, leading to a sell-off that added to investor anxiety. And unresolved banking stresses may very well be an overhang in the months ahead. It's still difficult to tell. But the banking sector issues created two concerns for investors. One was that this was the first sign of economic issues as a result of the Fed's aggressive monetary policy, which triggered fears about something else having troubles. Regional banks have historically played a vital role in the U.S. economy. One investment bank found that small and mid-sized banks account for roughly 50% of commercial and industrial lending, 60% of residential lending, and 45% of consumer lending. The second was the worry that banking issues reduce lending to businesses and consumers, leading to slower economic growth. But as you can see in the chart, the March concerns have eased quite a bit. A value above 1 indicates that the financial stress is above the long-run average, while a negative value signifies that financial stress is below the long-run average. As you can see, financial stress spiked in March following the banks' collapses. Those two banks collapsed, but it actually improved in April. So where are we now? Let's examine the present before we dive into what the future may hold. Let's take a moment to consider the variables that may weigh heaviest on the market performance. We believe that factors that led to the first half market performance may remain critical to how the market may behave in the second half. First, obviously, is the first factor is inflation. While accelerating inflation is no longer a concern of the market, some investors, and perhaps more importantly, the Federal Reserve, worry that inflation may prove to be sticky at these elevated levels. If inflation remains where it is presently, then it may hamstring the Fed if it has any intention of pausing interest rates in the second half of the year. In fact, one might argue right now that the Fed has sort of backed itself into a corner because it's already announced that, oh yeah, we need another July rate hike, but the data doesn't really seem to support a need for a rate hike. But now their credibility is on the line, so they have to look like they're really fighting. So there's some question about, are they really, could they potentially overdo it? It's hard to say. Sticky inflation obviously it has the potential of taking any rate cuts off the table. And until inflation can resume its march lower, the Fed is going to keep rates pretty tight until it hits its 2 to 3% target. I mean, I think we're there, but I'm not 100% sure that the Fed is convinced that we're going to continue down from 3% to 2% where they'd like to ultimately see it. Recession concerns also have weighed on the market throughout the year, even as the economy has remained pretty resilient. However, cracks are appearing in the economy. Manufacturing is weak. The labor market is slowing. Manufacturing orders are slowing. Leading economic indicators have been trending lower. Added to this, China, which is an important driver of global economic growth, has experienced a smaller than expected economic rebound. According to consensus Wall Street estimates, corporate profits may actually increase in the second half of the year, thanks in part to greater efficiencies, lower headcount, reduced capital spending, a weaker dollar, and a still strong consumer. Expectations are modest, but healthy earnings surprise may lift investor sentiment and drive higher valuations. It's really difficult, obviously, to predict where future corporate earnings would be going, but I think this gives you a little perspective on some of the things that people are weighing in that regard. So let's look at now what's ahead for the second half. Try to look in our crystal ball here and see if we can determine anything. Economic growth may be an integral variable in how the market performs in the coming quarters. To get a better insight into how economists think the economy will perform, we took a look at the May 2023 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. We'll look specifically at the consensus forecast of 3 economic factors that may drive much of the market's perception about the state of the economy. First, it's GDP growth, then unemployment, and inflation. As you can see in the charts, the consensus view as of May 2023 is that gross domestic product growth is expected to be between 0% and 1.4% in 2024. Meanwhile, these same professionals are projecting that the unemployment rate remains low between 4% and 4.9% in 2024. And they expect inflation as measured by core personal consumption expenditures to be between 2.5 and 2.9. Now, you got to remember, forecasts are obviously based on assumptions and subject to revisions over time. There's a lot of financial, economic, political, and regulatory issues that may come up to cause the actual results to differ from these expectations. It's just something to bear in mind. Some market strategists look at the bottom-up earnings per share to help set their price target for the S&P 500 index. When setting a bottom-up EPS, market strategists focus their attention on estimating earnings for all S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. This chart shows the bottom-up EPS and the price of the S&P 500. So the S&P 500 is in yellow. The bottom-up EPS estimate is in white. A word of caution: this type of analysis shouldn't be seen as a perfect predictor of stock price performance. In this chart, notice how the prices have been trending flat to higher. We're talking about the yellow line now, right? While corporate earnings are trending lower. When evaluating this chart, it is important to remember that the stock market is considered a discounting mechanism, which means that it's always looking forward. So the pricing of the market, when you look at the index, it's discounting future earnings. Put another way, the stock market price today represents all available information about current and future events. How far forward is the stock market looking? Most would agree it's discounting at least 6 to 9 months into the future. So our stock price is seeing a turnaround in earnings? I mean, I think that's the big question, because the forecasters, you see, the forecasters are predicting lower earnings, but the market is continuing to advance. And I've touched upon this in the past, where historically the market pricing is going to reflect the recovery before earnings. And then when I meant that, I said before actual earnings. When we start to see actual earnings beat expectations, the market's already going to be well in advance. This is a little bit different because this is forward-looking expectations of earnings by various analysts, but the market's still telling us something. Either the market is overvalued, right? It's too optimistic. There's too much exuberance in the market, and it would have to come down if the corporate earnings are correct. Or it's telling us the estimates are not correct, that they're going to start going upwards. You know, I'm not. It's always risky to take a bet on this, but I would have to say, if you look at the performance, the predictive performance of the analysts at the beginning of the year and where they are, and if we look at repeated years, we look back, the analysts are typically getting those corporate earnings wrong. So my feeling is that if you look at this chart, probably I would go with the argument that, in fact, what we're seeing is earnings bottoming out, and we're going to see those start to trend higher, which is a good segue into my next slide. Because considering the importance of corporate earnings to stock valuations, the big question obviously is, what can we expect for future corporate earnings? In the previous image, it was clear that earnings have been trending lower during the first half of 2023. However, market analysts expect that earnings growth will improve in 2024, right? So if you take a look at the chart, you'll notice that the earnings growth projections have been cut for nearly every industry sector of the S&P 500. Near the center of this chart, you can see is the earnings growth potential for all companies comprising the S&P 500, which is estimated to be 11.6. So obviously, some sectors are expected to do better and others not as good. But so this is the projection for 2024. So you can see in the where projections were, and the gray is where they were at the 31st of March and where they are today. So they've all been revised downward, except for maybe a couple like utilities and consumer staples. But they're still expected to grow. So I think that we might be at the inflection point here, and that may be explaining why pricing over the last couple of months, we've seen some pretty strong rallies. We've seen inflation come down. We've seen a lot of heat taken out of the economy in the form of lower demand, lower manufacturing orders, input prices, like industrial input prices have been falling. So there's a lot of indicators that seem that the economy is starting to moderate. Obviously, the big question still is, is it moderating or is it going to collapse and we're going to go into a recession? I don't know if I'm ready to stick my neck out on the line for that one just yet. But if it is a recession, I would have to, my view is that it's going to be fairly mild. But, we'll have to see. So how long is inflation going to stick around? We saw this chart earlier. It's a little bit, this is not as long as the 50-year or the one that I showed before, but similar. It's hard to say where, again, with that the inflation fight and the rates, how much progress can we make and how difficult will it be? One aspect of inflation, in particular, focus for the Fed, as well as market analysts and economists, is what's called sticky inflation. Sticky inflation refers to the components of the consumer price index that have historically exhibited a greater stickiness and rigidity with respect to price changes. In this chart, 12-month sticky inflation is the orange line, while the 12-month CPI, the general CPI, is the gray line. Sticky inflation includes many service-based categories like medical service, education, personal care services, as well as most of the housing categories. And I'm going to make a quick point on the housing. The housing was one of the main drivers of why inflation was so stubbornly high. But new leasing contracts, we're talking about residential leasing, we're seeing housing rents drop. Like new leases, the prices are dropping. So as the old leases are stuck in line, as those leases mature, we're going to see the new people renting at lower prices. And there's been anecdotal evidence in the business news, and it's certainly showing up on all the realtor sites that are constantly monitoring this, and which means that housing, which is 31% of the CPI and along that range, has a lagging effect. And so there's a lot of people arguing, and myself included, is I think we're going to see inflation moderate further, and there probably isn't a need for the Fed to raise rates any further. That doesn't mean we're going to be cutting rates. It's just I feel like we're probably at the end of that rate hike cycle, and and if they, like I said, I feel like they backed themselves in the corner with another rate hike, but they have to be very careful right now, because if they go too far, then they could tip it in the other direction, where we could have not just disinflation, but outright deflation. And that would be a problem. That would start to be a problem as well. And that's where you'd start to see layoffs and things like that. So obviously nobody wants that, and that's the risk. So they might have to eat their words and do one quick rate hike in July, but I think that's probably going to be the end. Fed Chair Powell has often referred to stickiness in the service-related inflation. That's one of his main reasons why he's actually come out and remaining very hawkish on rates. But you can see we've made a very good progress on inflation. I think you're going to see that orange line at the end here kind of start to dip down this way as you see the housing component data start to factor in on the new leases and things like that. All right. So what's ahead for short-term rates? I mean, everybody's thinking about that, right? Are they going to pause? Are they going to continue? That's the million-dollar question. I think I've already addressed that. The next one is July 25th, coming right around the corner. I think they're probably going to hike, and the only reason why I say that is it's to save face. But I don't think there's much more in it. I don't think September, October, November. I doubt there's going to be. I think it's going to be paused, and they're going to wait to see the data. And if we start to see weaker economic figures, then there may even be rate hikes in the beginning of the next year. I wanted to bring out another thing here. This chart here is the 10-year the bond note. So you can see that. Look at that rapid spike in September of last year. Look at that, just this massive hike in long-term funding, and then it wiggled around, and here we are. This was as of a couple of days ago, is at 3.7. But it's interesting to look at it in perspective, in the long-term perspective, going back to this is the 50-year, right? So this was the long, great historical decline in interest rates. One of the reasons why we had asset bubbles, especially in real estate over that period of time, is because of this cost of financing going down. And of course, then here's the pandemic, and then we're climbing right back up. So we're still very low interest rates. And I point that out because everybody's thinking, oh, interest rates are so high. No, they're not. They're not high at all. They're actually normal. In fact, the long run yield on the 10-year note is around 4% if you go back 90 years or something. So if I would argue that the interest rate environment is normalized, at least from a long-term perspective, except for this. This is the yield curve. So here's our 10-year down over here. This is our 2-year interest rate. And you can see this is what we call an inverted yield curve, because it's supposed to be shorter rates here, longer rates here. Why? Because, I can annotate here. Let's see. This is like a normal yield curve, right? Like that. We're inverted. And the reason why is because the short-term rates reflect the Fed funds rate. They reflect the rates that the central bank is lending to other banks. And so it has to be at that rate. So short-term rates are quite high. It's been great for us because we've been investing in a lot of short-term instruments with very safe, treasuries that are, guaranteed, and we're getting 5%. But that's not sustainable. What the long-term rate is telling us is where rates are going to be in the future. And that's the differential. The short term is where they are, the long term is where they should be. And so in a economy that's growing, that's why you see a yield curve that's higher, in part because the economy is growing, but also in part because there's the time value of money. If you're going to lend money for longer, you expect a little bit of a premium for that, right? Because you're taking more risk. So that's the normal yield curve. We're in an inverted yield curve. This historically has been a prediction of recessions. The problem this time around is that the recession, first of all, it's the recession that never came. But the reason for that, I think, is in part because this whole problem that we got into was driven by stimulus checks and lockdowns, which were sort of artificial, non-private market driven events that caused a huge disruption in the economy. And now we're in the process of unwinding that. In fact, money supply has fallen significantly. That's M2. That's a little bit too much finance speak, but money supply is falling rapidly. That means liquidity is tightening pretty quickly. That means economic activity is probably going to slow. And so the interest rates are slowly starting to have a bite. And so I think what we're going to see is starting next year, probably a gradual cutting of those short-term rates and going back to a more a proper yield curve. Like I said, if it's a recession, it's going to be mild. I'm still holding out for what we call a soft landing, where we still have slow but positive growth. But the jury's out on that. Here's another relationship that we've talked about in the past. It's a relationship of bond yields to bond prices, and they have an inverse relationship. So after experiencing years of low interest rates, some investors were probably surprised to realize their bonds last year could lose money if sold before they reach maturity. Bond values may decline during periods of rising interest rates, longer term bonds obviously being more susceptible. But a changing tide in the economy doesn't mean you have to abandon a fixed income. Even though we've had all these, the rise in rates and the difficulty in navigating the fixed income, is still an important part of your portfolio. But you have to keep in mind that there's no guarantee that even with a diversified portfolio with bonds, it will enhance the overall returns or outperform on a non-diversified portfolio. The reason why historically we put bonds in is act as a ballast. 2022 was one of those years that it didn't really perform the way it was supposed to, but it's actually, we're seeing that dynamic come back into play in 2023. So it's obviously been a very good year for bonds. Here, really, again, and I think we say this most of our times, it's really important to tune out the noise and stay focused on the fundamentals. You can't react. Investing is not about reacting to headlines, whether they're geopolitical events or consumer events or whatever. So it's very important to stay focused on fundamentals. That's why we're here, is to help you stay focused on those. We've gone over quite a bit today, but I'd like to conclude with a longer term perspective on financial markets, which having this perspective, I think, is key when pursuing financial goals we've set for ourselves. After a disappointing 2022, we all recognize that frustrations may be high surrounding the progress of investments. That's why this analysis of bull and bear markets during the period from May 26, 1970 to October 12, 2022 is critical to review. Here we see the average bull market lasts nearly 76 months. On the other hand, the average bear market has run a little over 15 months. As of May 2023, we were in a bear market that started in June 2022, when stock prices dropped 20% from a recent high. Into early June, however, some were saying we entered a new bull market. I think there's a wide variety of opinions on that. It seems to me that the bull market case is definitely building momentum and it's showing up in the data. But as we can see, really what this chart tells us is the rewards of a growing and innovative economy often go to investors with the discipline to remain invested over the long term, right? We can make tactical allocation shifts and things like that, which we've done a little bit, but we've shifted a little bit in our core series. We've shifted to more longer term bonds to take advantage of the higher yields that are there now. And we think it's a very good time. So there's tactical shifts to be made. There's tactical allocation into certain areas of the economy, and thematic growth being one of those, which we've talked about before. The next point I'd like to convey is kind of a cautionary one on the temptation of getting caught up in exciting new investments. This chart illustrates such exuberance happens from time to time. As you see, faddish themes have occurred fairly frequently since the 1970s, when gold rallied higher only to trend lower for a very long time. These trends can develop in broad markets like Japan and Asia in the late 80s and 90s, or they can form in certain asset sectors such as internet or biotech companies. Recently, artificial intelligence, or AI, has been receiving quite a bit of attention. What I want to emphasize is the importance of following a long-term investment strategy and not getting sidetracked by the fads. Does AI offer the potential of meaningful capital growth for investors in the years ahead? I think it certainly very much will. But there are all ways to incorporate AI into an investment strategy that takes into consideration your goals, time horizons, and risk tolerance. So, and I do want to say that we actually do incorporate some robotics and AI in small portions through an indexing approach through one of our ETFs. So we get exposure, but it's not something that we're chasing. It's in there as a long-term component of our strategy in our investment portfolio series. So keep in mind that some of the investing fads you're looking at can be considered sectors of the stock market. Because of their narrow focus, a sector investing strategy tends to be more volatile than an investment strategy that is diversified across many sectors and companies. Sector investing is also subject to additional risks associated with particular industry, and sector investing can be adversely affected by political, regulatory, or market and other economic developments. So my point here is really be careful of chasing these fads that come up, and I'm sure most of you are not thinking about that, but we as advisors get a lot of calls about this stuff, and we also get a lot of people trying to get us to invest in those things. And my point being is that certainly there's going to be some great economic value created in some of these thematic growth areas like AI, robotics, electric vehicles, clean energy, and other things like that. But you have to have a disciplined approach on how you invest in those for the long run. And we have a very disciplined approach. It's an index-based approach, so that we're not taking too much of specific bets, either in one company or even in a sector overall. So we like to call it tactical allocation, which is the practice that we have in our portfolio management. Okay, now it's time for questions. I think, Hiromi, we can unmute. Again, I apologize for that little few minutes delay, and realized by annotating I was going to lock myself out of the presentation, but love to have, any questions that you're thinking about. And if not, if you want to give us a call separately, that's fine too, but I'll open the floor up.
Well, my only question is about Charles Schwab. I know about it, but I don't know at all what the company Charles Schwab is like. So what is your assessment of working with Charles Schwab rather than an independent TD Ameritrade?
So TD Ameritrade is our what we call our custodial bank. So the custodial bank is where your assets are held in your account's name. So if it's an individual, it's individual. If it's something else, TD Ameritrade and Charles Schwab were basically both custodial banks, right? So they're like sort of on a sort of high level, fundamental level, they're basically they performing the same service, and they're both independent, right? They both had similar models to in terms of they definitely had a retail arm and then they have an institutional arm. We work with the institutional side. Uh, we're we work with Schwab Advisors, which is the institutional side at Schwab. So really, there's not going to be there really won't be much of a difference. I mean, you're going to see Charles Schwab on your statements and things like that, but that merger is just really just a merger of two custodians. It creates size. It creates benefits. It lowers the costs of running the custodial services, which is better for you guys. That's ultimately what the logic of the merger was. There's a lot of players. There are a lot of custodial players out there. There's Pershing, Fidelity. There's a few other big ones, and there's a handful of like mid-sized ones as well. We are always doing our due diligence on our custodial banks, meaning it's one of our requirements is to look at see if the custodial banks we're working with are providing the best service for our clients. So we do that usually once a year. We're looking at it, but it's not. Having said that, it's not easy to switch to another custodial bank. Like this one is actually going to be quite simple because they're not requiring a repapering of all the accounts into Charles Schwab. They're buying it and they're merging it. It's automatically going to become Charles Schwab. If we as advisors said to our clients, hey, let's go over to XYZ custodial bank, we'd have to repaper all the applications, meaning do all the applications all over again and bring them over. So there's, on the one hand, there's tremendous switching costs. So the benefits have to far outweigh that switching cost because it's difficult on the clients and it's difficult on us. The beauty of this merger is that we don't have that problem. And so for now, we're going to stick with Charles Schwab and obviously see how it goes. And we've already started opening new accounts there. We're not opening new accounts at TD Ameritrade, so we're getting a feel for it. It's pretty good so far. So we don't have any concerns. I mean, for us, as portfolio managers, our big thing is the portfolio management system. They are actually good at Schwab is going to retain TD Ameritrade's system because it's, from what I understand, it's probably the best in the business. And so because TD had very good technology. So that is staying on. That's very good news for us. So I don't see it as a problem, except a little bit of, like I said, the login credentials and things like that. So that's maybe the biggest headache that we're going to run into.
Just a matter of size among custodial banks. Where does Charles Schwab rank?
They were number one,
and
they bought, and I think TD was number 3 behind Fidelity.
Oh, so
now
we're talking about giants to begin with, getting bigger.
Yeah, this is a merger of giants. Yeah, these guys are big, and that's why I said that Schwab is now going to be the undeniable 800-pound gorilla in the market. So, yeah. Any other questions?
Yeah, this is Kenneth. Hey, Daniel, just a question for you about the EV market. Elon Musk just, I guess, announced that he's going to do some more aggressive price cutting. And I know that I think Ford has already kind of been trying to match that. Is that just a kind of isolated kind of battle in a specific market for market share, or is that is that kind of signs of deflationary activity?
I mean, it is deflationary, and new car prices and used car prices have been coming down, and that's contributed a lot to
Mm.
lowering of inflation in general. Now, EVs, if you recall, some of the things that we've talked in the past, and maybe we haven't talked enough about it, but um, with uh, those thematic growth sectors like EVs, I've named a few today, but EVs, like we invest in those again on an index basis. What we're looking at when we look at that market, so call it EV and electrification, which includes batteries and stuff like that. You're looking at the fundamental question is where are you on the adoption curve of that technology? And we're still really early days. California has higher adoption rates than other parts of the country, but if you look at the country as a whole, and certainly globally, adoption rates are very low. So part of what needs to happen in order for adoption rates to go up is electric vehicles can't have premium pricing compared to traditional internal combustion engine vehicles. So you're going to need to see, this is a necessary step for market expansion, is to bring the price of those things down. China is already making a tremendous amount of EVs, and they're making them for $20,000. So they're way ahead in terms of a mass market electric vehicle industry. Here, it's still, unfortunately, it's still been seen as premium. And I think Musk is realizing, hey, we've got to make this mass market. And as they bring prices down, you're going to have more adoption. And that doesn't mean that Tesla is going to run afoul and corporate earnings are going to drop. If anything, it'll mean volume will increase. So, but it does, obviously, like every other industry, at some point in time, it becomes commoditized, but we're far from that. I mean, choice is still relatively few in the EV market space compared to, traditional vehicles. So it will affect inflation in vehicles, but I think it's really obviously in the EV market. I think it's good news. I think this is a necessary step towards larger adoption rates, and I think you're going to see corporate profits continue to grow in that sector, and probably at the expense of the traditional car market. So that's why we want to be in it, because the car market's just gigantic, and there's tons of economic value there and to be had. And I think that Musk and Ford and some of these others, they're making the right decisions. So I see that as a good sign myself from an investment perspective. Good question, though. Are there any other questions? No stumpers? Anybody have a stumper for me? All right. Well, I think what we'll do is we'll sign off here. If any of you want to reach out on an individual basis, of course, we're always happy to set an appointment and talk about your investments and go over them so you have a better understanding, and then talk about the outlook and everything. But if there's no additional questions, we'll say goodbye, and thank you for staying for our webinar.
Thank you.
Okay, bye-bye.
Bye.